Income tax 2020, tax software example, other kinds of income. Come in, relax with income tax 2020. Here we are in our Lacert tax software. You don't need the Lacert tax software in order to follow along. However, you might be able to get a 30-day free trial from Lacert. It might be a useful tool to practice with, but we will be concentrating here on the Form 1040 and related schedules, jumping back and forth from the data input to the tax forms, the data input and software, allowing us to do that more quickly, focusing in on some of the other type of incomes that we looked at in a prior presentation. So we'll be looking briefly at some of these schedules, Schedule C, E, F, where you put data input for a K1, and then other income items including prizes, jury duty, forgiveness of debt, insurance, gambling, winnings, and so on and so forth. Now these items up top, the business Schedule C, Schedule E, and the Schedule F, are basically other income statements. So they're going to have income and expenses. They will typically add a good level of complexity to the tax return. So we might go into some of them, including at least the Schedule C and possibly Schedule E in the future. And then again, you want to be aware of whether or not you want to be picking up clients that have more complex type of returns related to them, like complex business returns, complex Schedule Cs, and Schedule E, and so on. But just to understand the schedule, we're at the 1040. The Schedule C is going to be down here. We'll talk more about this in a future presentation. This is going to be profit or loss from a business. Basically, it is an income statement. Notice that it includes both income and expenses here. And then basically the net income would then flow into the Schedule 1. So the Schedule 1 would then have the business income here from the Schedule C, which would then flow in to the Form 1040. But again, note there's other kind of complications to it related to it, including possibly self-employment tax, which would be Social Security and Medicare, and other items that could be related to it that we want to be aware of as well. Schedule E is rental income typically. So if it's a rental income, we're going to be down here. Similar kind of process. You might be saying, hey, why can't I just use a Schedule C for it? Sometimes there's going to be different rules for the rental income. It could possibly be subject to passive activity rules, where there could be different rules related to especially the losses that could happen if you have a loss on the business income. So again, kind of a specialty area, but similar kind of process. You basically have an income statement. Income statement then flows through to the Schedule 1. Line 5, that then flows up to the 1040, into the 1040 and the income line item on the 1040. Next, we have the farm income, and this is probably more of a specialty area because there's a lot of different areas related to farming. So you want to be, again, aware, do you want to be picking up the kind of clients that have farm income, or do you want to be basically recommending someone who specializes in that area? So just be aware of that, but similar kind of process here, basically income statement that would be attached. It's going to be specialized to the industry. Then it's going to flow through to the Schedule 1, back to the Schedule 1 for Schedule F, and then that's going to flow into the line 1 of the income statement. So notice in income up top, it's going to be on our tax equation up in the income line, although it includes kind of a lot of expenses, because all the expenses are basically deductions. They're basically business deductions that aren't on the top of the 1040, but rather included in the subschedules. Now then we have the pass-through entities, which will basically be K1s. The partnership and S corporation, if someone has partnership or S corporation interest, then that would be done on a separate tax return. We may touch in on that a little bit more in the future, but the K1 is what would then be used to have that income flow through. This is what we would call pass-through entities to then the tax return. So you'd be putting in the data input for the K1. If we went to the data screen and we go to the income dropdown, we'd be looking at pass-through entities down here, and then K1s for a partnership and S corporation, for example. And the data input will mirror the K1 pretty well. The K1 looking something like this. And then that will flow through then typically to, once again, Schedule 1. And then that would flow through to the 1040. So if you had a K1, and it's fairly basic, it's not too difficult to enter the K1, but the question would then be, do you want to start picking up the tax returns for the S corporation possibly, or the partnership, which can be more complex things to enter into the system. So just enter in a K1, not too bad, similar to some of the other things we talked about, but to actually do do the S corporation return or the partnership return can be more complex. We might touch on them again more in the future. Now, these are things that aren't quite as complex, and you don't see them as often. They don't come up all the time, and they're usually reported in basically other income, but you want to have an understanding about them because they will come up from time to time. So we might have prizes and awards. So you might see a 1099 miscellaneous, for example, line 3, and you're going to say, what do I do with that? Notice that this went to the IRS. You got to report it somewhere or have some justification as to why you wouldn't, because it's likely if you do not report it, the IRS will basically, flag that maybe because they have the information on their side. So most of these items are going to be in Schedule 1 over here. Schedule 1, they're going to be going on line 8. So if I right-click on line 8 and jump to the tax return, then I'm looking here at miscellaneous. So they have, these schedules are the schedules in Lacerte that are guessing that might go into this line item. We're going to be down here just simply in other income, and then I'm going to add other income. Now, you got to be careful when you add other income that it's not subject to self-employment. If it's subject to self-employment, then you're going to end up with another tax, Social Security, and Medicare on it. So in other words, if I was to add this and say 1,000 here, we're going to call it prize, a prize of some kind of 1,000, and say okay, then go up to the forms and see where it lines up on the forms. There it is. There's the prize, just what we would expect on the additional income. And if I go then to the form 1040, then it's simply going to be down here on line 8 included there. It increases the income. It's going to be taxed at ordinary income rates. Notice then on page 2 then, we just have the calculation of the 15,350. Now notice a common error that we could do just simply in data input is mistakenly not put it here, but rather put it basically up top, income subject to self-employment. 1,000, and I'm just gonna put 1,000 here, and then say okay. Now the difference is if I go back to the forms, page 1 still has the 1,000. That looks correct, but now we've got this adjustment on Schedule 1, and then on page 2 we have then an added tax on line 23, and that's related to the self-employment tax. So that's what you want to be careful of. You don't want to charge self-employment for a 1099 that's not subject to self-employment. If it was a business income, it would be subject to self-employment. Most of these other items will not, and you just want to make sure that you put it into the other income or wherever it goes that's not subject to self-employment. So then some of these other ones will be similar. So jury duty is usually not going to be, it's not going to be a significant dollar amount, but it's possible depending on their relationship with their employer and whatnot with jury duty, whether or not it's going to be taxable. If it is taxable, you're going to get a 1099 typically for it, a 1099-G possibly, and you're going to say, well, what am I going to do with that? Well, typically it will once again go into that other income. So now we would go into the other income on Schedule 1. That's it. Okay, it's probably going to go into other income. Right-click on that. And then Lacerte here gives us a nice one that says right there, jury duty. So it's, all right, jury duty. And they have a separate data input screen, basically same result as if we put it down here in other income, but they got this separate screen because it's fairly more common. So I'm going to say jury duty right there, and then forms, and that pulls it into jury duty, gives us the label for it. That then pulls over to page 1 on the 1040, increasing the taxable income once again. No effect for Social Security tax, so there's no added tax or anything like that, no different rates or anything funny. You just got to add it in that funny spot, which is other income, which isn't too funny. That's the only funny thing. And then we could have, what's the next one? We might have forgiveness of debt. So once again, that's a little bit harder for one to understand for the client oftentimes, because you get this 1099 for forgiveness of debt, and they're like, hey, look, I didn't make any income. I owed money, and now I don't owe money. But to the IRS, it's basically often going to be income, because it's kind of like they gave you income and then you gave it back to them to pay off the debt, which means, they basically gave you in. If someone gave you income and you used it to pay off the debt, then that would be basically income. So if you're forced to forgive debt, the default position typically by the IRS is it's income, unless there's some reason that it's not income. So if in any particular situation where there's forgiveness of debt, you want to make sure that what that situation is. And if you do not think you need to report it, or you get some other deduction or something related to it, then you want to make sure you document that, because once again, if you get a 1099-C, then the IRS has it, and it's likely that if you do not report it, then the IRS will question you about it, and you want to make sure that you have the documentation in order to support whatever position you are taking. So, but then if you put this into the system, again, same kind of process, we would say, all right, now where would that go? I got a 1099-G. Usually the difficult part here is explaining it to the client, you know. So I'm going to jump in, and we're going to say, all right, other here, and then jury duties not gone. We got forgiveness of debt, right? Which I'm probably going to misspell, but forgiveness of debt, 1,000, forgiveness of debt. And then okay. So once again, we're going to roll on up here to the 1,000 rolling in here. And once the client looks at that, they're going to say, hey, why do I have a 1,000 there? I don't think I should have that. And then you'll have to, go into why or why not it should be included, why or why not, and so on. So, but in any case, that's where it would go. If it is included, you would think, that's a place you could put it. There it is, adding to the 101. And then again, it's not subject to self-employment tax. Make sure that you're not paying self-employment tax on anything that's not subject to it. All right, and then we're going to go back on over and say, all right, what's the next one? See what else we have here. We've got gambling winnings. So gambling winnings, so this is one that you won't see often, but sometimes you got clients that they like to gamble, right? So you got gambling win, they win from time to time on it. And if it's like a casino or something, if it goes over a certain dollar amount, the IRS, just like any other kind of earnings that are paid out, say, hey, casino, do you want to deduct the fact that you paid out winnings? And they're going to say yes, and they're going to say, great, then tell us who you paid the winnings to so that we can get the money from them on their taxes. And that's the reporting of the W-2G. So if you get the W-2G, you're going to have to report it. The common question there is going to be, well, if I had gambling winnings, do I get to deduct the losses? Only if you itemize. If you itemize, then you might be able to get a benefit for the losses. So let's see how this works. Now, also note that the casino may be required to take withholdings too. So if someone won a substantial amount, they may take withholdings from the amount as well, because the IRS might require them then to take withholdings in estimated payments. Or you might tell them, hey, withhold, so I don't owe taxes based on the winnings. So let's see this, and let's go back on over and say, all right, winnings, gambling winnings, and jump to that. And that's going to be a W-2G typically. So now we have gambling winnings. And so I'm just going to say this was at our local casino. And let's say we won like 20,000. We had a good time. So typically they want the information like on a W-2 now. So we're providing the more detail on it, the address and whatnot, and the federal identification number that should be provided on the form documentation. And then we're going to say 20,000. Let's say we withheld 25% of it, which would be 5,000. So we're going to say there was withholdings of it, just kind of like on a W-2, 5,000 that was withheld. Might have state withholdings too. We're just looking at the Fed at this point. So then if I go back up, I'm going to say, all right, let's go back up. And then I'm going to remove the 1,000 I put. We had 1,000 somewhere else, didn't we? For like, let's get that one out. I don't want to confuse things. We'll delete that one. Okay, and then we're going to go back up and say, all right, now the gambling winnings are included. So there's the 20,000. So that, of course, still rolls into the Form 1040. So there's the 20,000 increase into 120, and that now we're at the 107.6. It's not going to be subject to self-employment, so we don't have any kind of added tax over here. But we did have a withholding. So now we got this withholding of the 5,000. This is the money that came out. This would be on the bottom half of our tax equation here. And I know I'm not putting all these into our equation, but I want to go through many examples at one time. So that would be, part of the payments that would be down here that we would put, and we would put those in separately to our form, and just like we would with a W-2, and see the withholdings after the tax calculation on it. Now, if there was any kind of deductions on a Schedule A, they're going to say, well, what about I have these losses of 25,000 of losses, and if you have the data for them, supporting documentation, you'd say, okay, well, that would be on the itemized deductions. And actually, I'm going to put them in the same screen as where the winnings were. So now we've got total gambling losses. Now let's say the gambling losses were like 10,000. Let's say they were 10,000 on the gambling losses. And so then if I go back to the forms, then now I've got gambling losses here to the extent of winnings. They're going to be limited by the extent of winnings of 10,000. And of course, if you had those, you'd have to support them in the case of an audit and whatnot. But that 10,000 is less than, if I go back up to page 1, it's going to be less than the 12,400 that they got for the standard deduction. So they may not be benefiting from it. Now, if you have someone that's itemizing, then they would benefit, right? If I go back on over here and I said, well, what if the gambling, and I'll jump there, and I'm going to say, what if I jump there by going to the Schedule A, and then I'm going to go down and say, what if I jump there and say we're going to go to the gambling losses here, and let's say they were 15,000, and I go back on up and say, okay, well, what's that going to do? If it's at 15, now if that's my only itemized deduction, which is unlikely because we might have other things that would be included, but that in and of itself puts us over in terms of the itemized deductions. So now we're itemizing. The benefit, however, isn't the full 15,000 because it took us to get over 12,004 in order to itemize at all at that point. So that's kind of what you got to do with the itemized deductions. Now, it's possible that whatever losses we had, I mean, maybe we only had 10,000 losses, but we also itemize already. You might say, well, what if I already itemize, and we go down to the deductions and itemized deductions because possibly we have interest on a home or something like that, which would be one of the major itemized deductions. And we'll talk about that later, but let's just put interest in there, interest in here, cancel. I'm going to put interest in here, 20,000 just to fill. And then if I go back to the forms then, so now of course, if I go to the itemized deductions, we are itemizing because I've got the home mortgage interest and then the 10,000, which definitely puts us over to the point of itemizing, and that will then make those gambling winnings more beneficial. Now, if I go back on over one more time, let's do this one more time and say, well, what if I go to my Schedule A? What if my gambling winnings were 25,000? I add them all up and they're at 25,000. So I'm going to say gambling winnings or gambling losses. Let's do that one more time. I'm going to jump there. You're going to jump to the gambling losses. And let's say they were 25,000 in losses. And then I go back on over. And so now they're limited to 20 because they're limited to the amount of the income. So it's going to be, you can only take the losses. You have to have the documentation for them. If you have the documentation, you can only take the losses up to the point of the winnings, and you can only take them as an itemized deduction, which means you're only going to get any benefit if you itemize to the losses. So if you have someone that gambles and they itemize basically, or they think they might win something that will allow them losses high enough to push them over itemizing, then yeah, it might be worth you tracking your losses so that we can deduct those. If not, if you don't gamble a lot and you don't itemize, then it might not be worth your time to track all the losses unless you had, a significant winnings that would then constitute the need for us to be sorting out the losses needing to be great enough to clear the standard deduction in order for them to have a tax benefit.